We continue with our discussion on Unit 3 mutual funds and wealth management, and now we look at the various other categorizations of mutual funds. We've already seen categorizations based on underlying investments, and we had seen those categorizations to be in equity, in debt, in both, and in others, right? So those are the four kinds of categorizations based on the underlying investments that we had seen. Now we look at more ways of categorizing mutual funds, which is, are we going to categorize it based on investment restrictions, when you cannot invest? Method of purchase, do you purchase it yourself or do you go through an intermediary that comes in? And tax treatment under various options. You could also call it as whether you are getting a cash flow intermittently or not from a mutual fund. That's where the third kind of categorization would come in, right? Now remember, in the first one, the categorization was based on what was the underlying. In some of the second, third, and fourth ones, it's the same portfolio that we're looking at, just that they're getting categorized in different ways, right? Let's take a look at the first one. So based on investment restrictions, what we call as the categorization is a fund called open-ended or closed-ended fund. We will look at this in more detail as we go along. Based on method of purchase, you could either purchase it directly or it is into something called as a regular plan. Based on tax treatment, you could have a growth option, a dividend option, and a dividend reinvestment option. Remember that method of purchase and tax treatment basically work on the same underlying portfolio. There's no difference in the portfolio. Here, obviously, we are talking about different funds. Open-ended and closed-ended are two different sets of funds. But in direct and regular plan, you can have the direct and regular plan for the same fund. Growth, dividend, and dividend reinvestment option can also be for the same fund. These are options purely to enable investors try various methods of tax treatment or purchase, right? We'll look at those in more detail as we go along. Let's first start with the fund based on investment restrictions. An open-ended fund is a fund in which an investor can invest at any point of time, invest in and get out at any point of time, right? So no restrictions. No restrictions in terms of when you are investing and when you're getting out. So that's something called as open-ended fund. A closed-ended fund has some restrictions in terms of when you can invest or redeem. For example, there are some funds which you can only invest during some windows during the year and can redeem only after a certain number of years, like 4 years, 5 years, 3 years kind of a thing. If you try and redeem earlier, there are either they don't allow you, or there are going to be high costs associated with it. So a closed-ended fund is a fund that has restrictions in terms of both investment at any time, any point of time. Most of the closed-ended funds have restrictions on redemptions. What do we mean by redemptions? When we are taking our money out, that's when they will put a restriction that you cannot do this within 1 year, you cannot do this within 2 years or 3 years or 4 years or 5 years. And if you do so, there is going to be an extra charge, right? That charge when you are getting out is something called as exit load, right? So if you get out of a fund and you have to pay a charge for that, that's called an exit load. So effectively that's there. If you get into a fund and there is a charge, there is something called as an entry load. In India, now there is no entry load. Entry load has been abolished. Exit load stays still with certain kind of funds, and that's basically because they would want to discourage people from getting in or getting out at any point of time. So that's your open-ended and closed-ended funds. That's broadly the contour of the kind of funds which are available in terms of your investment based on the restrictions on when you can invest and when you can get out. Then you go to the next one, which is now going to look at the same fund. So it's the same underlying portfolio. You can either purchase it via an advisor or a bank or an intermediary, right? That's called a regular plan. What happens here? The mutual fund passes on a small commission to this sales agent on your money. So you have this money that you have invested. From your money, some part of the commission will go out to the uh, to the uh, to the sales advisor in between or the intermediary in between, right? If you are aware of how do you want to invest, where do you want to invest from, you could go into the direct plan on the same fund. In this, the investor invests directly on his or her own, going directly to the fund house. Since there is no intermediary, no commissions are deducted. So if you invest 100 rupees in the regular plan, there will probably be a commission of 0.5 and your investment will be 99.5. If you are investing in the direct plan, there is no commission and hence the entire 100 gets invested. Obviously, the NAV, remember we said NAV is plus expenses is equals to total assets. If expenses are low under the direct plan, the NAV is going to be higher. So for the same fund, you could have both the regular plan. For investors who don't want to do it directly, or they don't know how to do it directly, or they're not tech savvy, or they want someone to kind of guide them on investments, that's where regular plans will become useful. But for investors who are experts, they can do it themselves, they will go to the direct plan and invest it directly, right? That's the classification based on the method of purchase. The third classification comes on based on the tax treatment, right? Now again, remember we're looking at the same portfolio. We're looking at the same portfolio. It is just a way of how cash gets returned to shareholders, right? In the growth option, so we have growth, dividend, and dividend reinvestment. Under the growth option, the mutual fund value grows or declines based on simply the appreciation with the underlying portfolio, right? So let's say the mutual fund starts with 1000 crore and the value goes up to 1100 crore and then it gets 10 crore of dividend, right? Some stock might give a dividend. This dividend is basically going to get added to the pool and hence the overall value will be 1110 crore under the pool. And if you started with an NAV of 10, you will end with an NAV of 11.1. That's the growth option, right? Some funds, however, sometimes some people may want dividends. They want to say that this 10 crore, why do you rather add it here? Why don't you give it to me? So the fund can keep giving some returns in the form of dividend payouts. Now we could be three investors. One investor A says, I don't want the dividend. Investor B says, I want the dividend. So for investor B, you could give the 10 out, right? Dividends are tax free in the hands of investors. There are rules that have changed with regards to this in terms of very high dividend income that people have. So if you have dividends more than 10 lakhs, then there is a tax there. But otherwise, in the investor's hand, dividends are tax free. So sometimes the investor ends up saving tax on these returns. So if you want some inflows happen intermittently, you will opt for the dividend option. Dividends are logical, like just same like stock. So if the NAV of a fund is 15 rupees and it gives a dividend of 1 rupee per unit, remember dividend is typically on a unit basis, then post dividend NAV will work just like the stock price works. That will become 14. Why? Is because NAV is the amount of money the fund house basically owes you, right? If they've given you a dividend of 1 rupee per unit, the NAV will be 14. In our earlier case, if this 10 crore came out as dividend, the NAV here would now under the dividend option be 11 rupees. So the growth option will be 11.1, the dividend option will be 11, but at no point remember this is a different portfolio. It is the same portfolio we are looking at. So always remember this and keep this in mind. Then there is a third investor who comes in and tries this new option called the dividend reinvestment option. That's an interesting one. In this case, there is a dividend declared, right? So dividend gets declared, but it also gets reinvested. So the money that you get as a shareholder, as a unit holder, instead of giving you the cash, they take the cash, so cash used for new units. When that happens, things become interesting, and that's where tax benefits start accruing, especially if you are playing it in the short run, right? If you are investing for more than 1 year in equities, and we will again come back to this under unit 5, if you're investing for more than 1 year in equities, there is no taxation on the gains that you make. It's long-term capital gains tax, and that is zero on equities in India, right? If you are, however, selling at less than 1 year, there is a short-term capital gain tax if you are making money, and that's taxed at 15%. And that is where this option becomes handy. Let's understand how, right? Take an example. Funds invested in mutual funds with different options could have different taxation treatments. An investor invests rupees 10,000 in a fund with a NAV of rupees 10, thus she ends up getting 1,000 units. The fund grows by 30% in 11 months, after which she decides to sell it. So it's selling after 11 months, so it is short term and there's a growth of 30%, so it's a capital gain, and short term capital gain gets taxed at 15% in India, right? So remember that. Now let's look at the tax implication, assuming she invested in the growth option and assuming she invested in dividend reinvestment option, and the fund declared a dividend of 2 rupees per unit, somewhere in between, out of this 30 rupees, 30%, 3 rupees, right? So 10 would have become 13 under growth option, and in the second one you have given a 2 rupee dividend as an option, right? Let's look at the case as to how it goes. The NAV of the fund goes up to rupees 13, right? In the first case, the growth option, portfolio value is 30,000. Upon selling, gains are 3,000, 13,000 minus the 10,000 you invested in, and tax would mean 3,000 on 15% would mean 450 rupees as tax liability, right? That's what happens with the growth option. Straightforward. You've sold it in less than a year, so short-term capital gain tax would apply, and that would give you a 15% of 3,000. Remember, it's only on the gain. The tax is only on the gain. So the gain is 3,000. You put 15% on this. 15% on 3,000 gives you 450 rupees as the tax liability. Now let's look at what happens in the dividend reinvestment option. The NAV of the fund goes up to 13. At this point, let's assume the fund declares a dividend of 2 rupees per unit. How many units did the investor have? 10,000 rupees divided by 10, that's 1,000 units. Per unit, you have 2 rupees of dividend, so the amount is 2,000, correct? Now, in the reinvestment option, you will use this 2,000 rupees to reinvest and buy more units, right? So now the reinvestment will happen on the post-dividend NAV of the fund. And what is the fund's post-dividend NAV? You've returned rupees 3, so rupees 2, so 13 minus 2 is going to be 11. Post-dividend NAV is 11. So the investor effectively gets 2,000 rupees. She gets 2,000 and the unit NAV is 11. So you take 2,000 rupees, divide that by the NAV 11, and another 181.8 units are issued, right? What is the total units that you have now? You have 1181.8. Total fund value is now at a NAV of 11 because 2000 was the dividend amount that was taken, 2 rupees was taken out. Note that the total fund value is same as earlier. There is no difference on this, correct? Tax, however, will be calculated differently. On the first 1000 units, you bought them for 10 and you sold them for 11, so your gain is 1000 rupees, correct? This is short-term capital gain tax because you have effectively sold those at that point of time, if you are selling it now just after the dividend. On the next 181 units, on the next 181.8 units, you got them at 11 and you sold them at 11, so there is going to be no income because of that, and so there is no tax because of that, and hence the tax amount is 150 when compared to earlier where the tax amount was 450. So there is a gain of 300 rupees on the tax that you see, correct? That is the benefit of a dividend reinvestment option. Let's relook at this. So the NAV of the fund goes to 13. 2 rupees per unit dividend gets declared. That amounts to 2,000. This 2,000 gets reinvested at the post-dividend NAV, which is going to be 11 rupees. So 2,000 rupees invested at 11 rupees of NAV will give you 181 new units. Total number of units would thus become 1,000, which was earlier there, plus 181.8. That gives you this, and the fund value remains the same as the earlier case growth because that's the underlying portfolio, right? Whether you give out 2,000 rupees or that 2,000 rupees stays inside the fund, that's not going to matter any which ways. The tax on the first, and now let's say you sell this. So when you sell this, you receive 13,000 rupees. The first 1,000 units you bought at 10, you sold at 11 of NAV. So that's 1,000 rupees. That's short-term capital gain, 15% tax. The next 181.8 units you bought at 11 effectively, or you got this issued at 11 and you sold at 11. So profit is 0, right? When you sell it, obviously you will get 181.8 into 11, which is 2000 rupees. But it's assumed that you invested this 2000 and you're getting 2000. So there's no profit. And hence there's 0 into 15%. That's 0. You get 150 here, you get 0 here, and the total tax liability is 150, thereby saving 300 rupees from the earlier option. Correct? Let's look at it in a tabular format. In the first growth option, 10,000 invested, NAV is 10, units 1,000, tax gains are 30, NAV becomes 13, amount redeemed when you sell it is 13,000, profits are 3,000, 15% of 3,000 is 450, and that's the tax that you end up paying. Correct? In the dividend reinvestment option, initial amount invested is the same, NAV is the same, you get the number of units 1000, gains are 30%, NAV goes to 13, now you give a dividend. So once you give a dividend, 13 minus 2 gives you the post-dividend NAV, which is 11. Total dividend amount is 2 into the number of units, which is 1000. So that's 2000. 2000 rupees getting invested at a NAV of 11 will give you 1181 new units issued. Total units are 1181, which is, let's say, B plus A. So that's combined. Now this multiplied by 11 is going to give you the total portfolio value. Value of initial 1000 units is 11,000. Value of cost of new units and value of new units is the same. So when you sell the initial 1000 units, that's 11,000 minus 10,000, which was your initial investment amount. The profit on new units is 2,000 minus 2,000. Total profit is 1,000. Short-term capital gain tax is 150. And that is how the dividend reinvestment option saves tax for us. Correct? Always remember, however, that the underlying portfolio is the same. We are talking about the same portfolio or the same stocks that are there. Only then will this work, because the NAV has to go to 13 only after the underlying stocks have gone up as such, right? That's the third categorization that we see, purely from a tax benefit perspective. Also, it only works if you have a plan or chance to get short-term capital gain. Only then it works. If you're anyway going to hold it beyond 1 year, then it doesn't matter whether you invest in dividend or growth option. If your horizon is more than 1 year, it is simpler, rather than doing this calculation, it is simpler to just let it be in the long run in the growth option, because calculations become simpler. Here obviously you'll have to do multiple of these calculations, and then there's a cost of these calculations that comes in. But if you are invested for 5 years or anything more than 1 year, to be very honest, where short-term capital gain tax is not going to come in, then you might as well just invest in the growth option, right? That's the different kind of options that are available with dividend reinvestment and growth, and the tax treatment that comes along with it. So those are the three broad categories of fund categorization. As we end this particular section, a couple of questions. Explain how direct plans are useful for investors, and explain the difference between growth and dividend reinvestment options for a particular mutual fund. Thank you.